Welcome to the Explainer. So, if you've been keeping an eye on fintech lately, you already know the deal. The days of your banking app just acting like a passive record keeper, a glorified digital ledger of money you've already spent, well, those days are rapidly coming to an end. Today, we're diving straight into the 2026 shift toward predictive banking and agentic AI. It's a massive revolution, and it's fundamentally altering how we interact with our money. Think about the static banking apps we rely on today. Pretty soon, they're going to transform into what we're calling personalized financial command centers. Just imagine opening your app, and instead of staring at a static balance, you're greeted by this dynamic hub of autonomous financial action. It's literally working behind the scenes to optimize your wealth. It's a huge leap forward, guys, and it completely rewrites the relationship between you and your bank. Here's our quick roadmap for today. We'll cover the 2026 banking shift, meet your agentic AI, look at exactly how this AI thinks, explore the real-world impact, and then finally, we'll address the risks and limitations. Okay, let's dive right in. Section 1, the 2026 banking shift. The entire foundation of this shift boils down to predictive banking. Essentially, this is a financial model that uses real-time data and machine learning to forecast your future needs. Now, the absolute key phrase here is before you ask. Right now, we're stuck in a reactive system, right? You realize you overdrafted and then you scramble to transfer funds. But we're moving to a proactive system that spots that incoming shortfall and offers a solution days in advance. It literally anticipates what you're going to need next. Moving right along to Section 2, meet your agentic AI. So we're all pretty familiar with traditional AI by now. The basic chatbots. You ask for your balance, it spits out your balance. Simple. But agentic AI financial advisors? That is a completely new class of intelligent software. Agentic means they go way beyond just answering your questions. They actually execute multi-step tasks. They can understand your broad, overarching financial goals, pick the right tools, and actually perform complex workflows, like negotiating interest rates or moving money around on your behalf. And they do this with minimal human input. They don't just talk, they act. All right, let's lift the hood here. Section 3, how the AI thinks. I want you to think of this operating mechanism as a continuous 4-step loop of data and action. First step is data ingestion. The AI is constantly monitoring your transactions, market trends, even life events. Next comes pattern recognition, where the machine learning models pinpoint specific financial signatures, like it might spot a pattern that suggests a massive upcoming bill or a steady leak in your savings. Third is reasoning and planning. This is where the agentic part really shines. It breaks down a big goal, say saving for a down payment, into bite-sized steps, maybe finding some forgotten subscriptions you can cut, and finally, execution via API. The AI connects directly to banking systems using application programming interfaces to seamlessly move that money or cancel that subscription for you. But for that continuous loop to work securely, we need a few crucial puzzle pieces to snap into place. First, large language models, or LLMs. These act as the brain, allowing the AI to actually understand natural language and figure out your true intent. Then, we need real-time data streams. Banks absolutely have to ditch those slow daily batch updates and move to instant data. Crucially, we also have open finance regulations, like FIDA over in Europe, which legally let your AI agents securely access your data across competing banks and platforms. And rounding out the whole shebang is human oversight, which makes sure professional guidelines and strict risk limits are always respected. And this brilliantly illustrates how the AI actually processes a decision safely using all those tools. Let's say it detects you've got some excess cash just sitting idle. Step 1, intent identification. It flags the need to optimize that cash. Step 2 is the constraint check. Here, it reviews your personal rules. Stuff like, hey, never let my checking balance drop below $500, and checks that against banking regulations. Step 3 is option comparison, where it evaluates different paths. Should it move the funds to a CD, a high-yield savings account, or maybe an investment portfolio? And then finally, verification. Now, I really want to pause on that final verification step because it is absolutely vital. High-value actions will always require your one-click approval. Sure, the AI might autonomously handle low-risk, everyday routine tasks, and it'll log its reasoning as it goes, of course. But for major financial moves, it's always going to present a recommendation to you first. This human-in-the-loop design guarantees the AI stays strictly within your personal risk tolerance. You are still the ultimate boss here. The AI is really just your incredibly efficient chief of staff. Moving into Section 4, the real-world impact. This transformation is going to roll out along a pretty distinct chronological timeline. The immediate change, which honestly we're already starting to see, is traditional apps evolving into those financial command centers we talked about, where AI handles your daily tasks. Now, in the middle term, the actual nature of banking competition is going to shift. Customer loyalty won't be tied to the bank with the oldest brand or the most physical branches anymore. It's going to be tied to whichever bank provides the smartest, most helpful AI agent. And the long-term vision, we're looking at the emergence of the 10x bank. This is a highly efficient institution where tiny teams of human experts manage vast networks of AI agents to personally serve millions of customers. So what does this actually look like for us in practice? Well, for you, the consumer, it means having an AI concierge. This thing might automatically move money around to cover a bill if your paycheck is running a day late, or it might actively negotiate a lower interest rate on your credit card by constantly comparing live market offers. For the banks, their whole business model shifts. They go from just selling you products like loans to actually selling financial outcomes and health, earning advisory fees based on how good their AI's advice is. And for the workforce, bank employees are going to move way beyond basic support and data entry. Their new careers will focus on agent design and governance, making sure these AI agents behave accurately and reliably. Ultimately, the driving force behind all these massive changes really comes down to four main objectives. We've got proactive assistance, which solves problems before they even happen. Hyper-personalization, which tailors your banking perfectly to your unique life events. Operational autonomy, which frees up humans from boring, repetitive workflows. But honestly, perhaps the most important takeaway here is financial inclusion. By automating complex advice, the industry can finally provide high-quality, deeply personalized financial guidance to folks who historically could never afford a dedicated human wealth advisor. That's a real game changer. Now, what's really interesting about this next part is the flip side of all this convenience. Section 5, the risks and limitations. The first major risk we have to talk about is AI hallucinations. This happens when the AI perceives patterns in your data or the wider market that simply do not exist. Just imagine an agentic AI churning out a highly confident, multi-step financial plan to move your entire retirement fund, and it's based completely on flawed pattern recognition. If the system misinterprets a temporary market blip as a permanent, long-term trend, the advice it gives could be absolutely disastrous. Closely related to those hallucinations is a technical vulnerability called model drift. Look, financial markets are incredibly dynamic. If an AI model is trained on today's economic data, but the market changes drastically, say we shift from a low inflation environment right into a high inflation one, the AI's decision accuracy is going to decrease over time if it's not constantly retrained. Basically, an unmonitored AI model slowly loses touch with current realities, making big decisions based on a world that literally no longer exists. Furthermore, you have to remember that predictive banking relies entirely on ingesting massive amounts of your personal data. This creates giant centralized honeypots of highly sensitive information, making these platforms massive targets for cyber attacks. And finally, there's the giant headache of traceability. Regulators need to know exactly why a decision was made. If an AI executes some complex investment strategy, it can be nearly impossible to trace back the algorithm's logic unless the system is specifically built with explainable AI features from the ground up. A black box AI managing billions of dollars, that is pretty much a regulator's absolute worst nightmare. And that brings us to the ultimate question we all have to face as we speed toward this 2026 shift. We've seen the incredible benefits of proactive, hyper-personalized financial management, right? And we've explored the very real risks of hallucinations, data privacy issues, and model drift. The tech industry is rapidly building the infrastructure to autonomously manage our financial lives. But the final, most crucial puzzle piece, that's human trust. So I leave you with this to ponder. As these financial command centers come fully online, are you ready to hand your wallet over to an AI? Thank you so much for exploring this fascinating topic with me today on The Explainer. Keep asking questions and keep learning.